Hello, and welcome to the webinar 2023 Outlook, Legislative and Regulatory Trends Affecting Employers. My name is Eric Wallace with Argyle, and it's great to have everyone joining us today. I have a few administrative details to share with you, then we'll dig into our presentation. First, we'd like to thank Experian Employer Services for their partnership with today's event. They've been wonderful thought leadership partners to Argyle, and they're committed to providing you with valuable content and a great overall experience. Thank you again to Experian Employer Services. We appreciate you joining us today. We welcome you to stay connected during today's event. For those of you who are active tweeters, please follow us on Twitter at Argyle Exec Forum. I also wanted to take a moment to touch on our content neutrality policy, which we've curated based on the feedback we've received over the years from our members. Argyle is very proud and protective of this policy, and as it reflects our commitment to ensure the neutrality and overall value of the content presented at our events. We've worked closely with our speaking faculty to ensure that you receive a set of balanced and neutral viewpoints during the session today, and we appreciate our members' support of this policy. For those of you who are seeking CPE credit today, you must answer at least 3 polling questions and remain on the session for its duration. Polls can be found under the Polls tab on the right-hand side of your console, right next to Chat. Afterwards, if you're eligible to receive credit, you will receive an email with a link to your certificates. If you have any questions about credits, please email cpe@argyleforum.com. Finally, and most importantly, please submit all questions that come up during today's event into the chat section of the interface. Let's begin. Mara, you have the floor.
Perfect. Thank you. All right. Hello, and thank you everyone for joining us in today's webinar, 2023 Outlook, Legislative and Regulatory Trends Affecting Employers. My name is Mara Nickel, and I'm your MC for today's event. We hope that our webinar will help you today anticipate changes for your organization and prepare for new legislation. And we're going to kick off by introducing our fabulous panel of advisors. So first we have Wayne Rotker. He's our Vice President of Tax. Wayne has over 35 years of experience in unemployment compensation consulting and collaborating closely with government agencies on these topics. Next, we have Matt Kelly, who's our Vice President of Consultancy. Matt has over 15 years of experience serving clients in international, state, and local tax and tax credits and incentives. And finally, we have Gordon Middleton, who is our Senior Product Intelligence Analyst. Gordon has over 17 years of experience handling employer compliance processes, including I-9 and E-Verify, year-end, and onboarding processes such as W-2 and ACA. All right, and we'll move on to our agenda for today. Today's webinar will focus on 3 important topics. First, Gordon will take you through proposed changes to the Form I-9, and then we'll hand it off to Wayne, and Wayne will go through the unemployment tax landscape. And finally, Matt will take us home with current trends in unemployment taxes. And with that, I will move it on over to Gordon.
All right. Well, thank you, Mara. I appreciate that introduction. And thanks, everyone, for being with us here today. We greatly appreciate the opportunity to share our knowledge with you and just kind of have a look at how things are going as trends this year. First of all, before we jump into I-9, let's have a look at some of the headwinds that are impacting employers this year. As we all know, the couple of years prior to this calendar year have been rather tumultuous as well, but now that we've kind of come out of that, where employers are looking at other areas that are also causing some challenges. So let's have a quick look at those kind of to set the stage for what's going on in the year. So unemployment, obviously, as we've all heard all across the news, very low thus far this year. Kind of means it's a lot harder for employers to fill those open positions, especially when coupled with that mass resignation of a couple of years back and people all kind of doing new jobs throughout the pandemic. Now, on the unemployment front, layoffs are more prominent in specific industries. I think the tech industry specifically is having a bit of a tough time at present. So hopefully that's not going to spread across the population, but we'll just keep an eye on that and make sure that we're monitoring the situation. Employee engagement has obviously suffered a bit over the past few years. So it's important for employers to support remote and hybrid employees, make sure that they have everything they need to be able to get the job done, as well as ensure that they're all having good, consistent onboarding experiences across the board for new hires, as diasporic as they may be at present. And of course, employers are more concerned with retention in general these days, as it seems like that's kind of reached a culminating point where a lot of people have been moving about, causing all sorts of problems for onboarders, kind of employee tracking, making sure that we know where our employers reside at any given moment and the like. Obviously, data security is a bigger issue with that remote or hybrid workforce. Employers are trying to increase emphasis on employee information security and privacy, things like heightened security measures, biometrics, et cetera. Also, one of the big uncertainties that we keep hearing that is looming on the horizon is a coming recession. So we've got that to deal with. And with that, obviously, there's uncertainty surrounding corporate budgets. Uncertainty leads to caution. So obviously, employers aren't necessarily fattening up those budgets the way they may have done prior to the pandemic. So all of these situations kind of lead into a perfect storm where employers need to make sure that they're really paying attention to the legislative and regulatory landscape and making sure that they're coupling with good partners to make sure that they're keeping abreast of all these situations. Having said that, let's jump right in to a quickly changing situation at present, and that's the one going on with the Form I-9. So hopefully everybody with us, or at least most of us, know by now that the current Form I-9 expired as of Halloween last year. So employers are to continue using that old form until a new form is introduced. And a new form is on its way. Let's make no mistake about that. It has been announced as being a simplified version of a 2-page form, which seems simple enough on its face until you realize that that 2-page form has some 950 plus pages of regulation and guidance that accompany it. So they're looking to, with the introduction of the new form, they being USCIS, Customs, Immigration, the folks that handle the promulgation of the Form I-9, are looking to reduce that back to the form itself back to 1 page. Those of us who have been in the I-9 world for a while may realize, hey, look, going back to the old school 1-page form, and they're looking to do this by presenting only sections 1 and 2 on that initially presented form to new employees. Section 3, as we all know, was the form, or excuse me, the portion of the form that was dedicated to re-verifications and rehires, and they are now looking to make that a supplement, as that is something that occurs obviously beyond that initial hiring phase. So in order to kind of simplify the overall process and ensure people aren't necessarily so overwhelmed by the form at its initial presentation, they are pushing that out to be its own supplement. Now, the good news is the instructions are also going to be reduced. So hopefully with that will come some clarity and simplification so that they won't need that current 15 pages and are going to boil that down to 7. So you would think clarity would be much needed with that sort of brevity. So we'll have to wait and see exactly what's going on there, but we've got some good clues, okay? So some of the proposed changes to that new form, which have been shared, by the way, the list of acceptable documents is to be updated, and a link to List C documents will be provided. Now, that's currently confusing because there are certain acceptable documents that aren't specifically listed. I believe it's a C7. They kind of use a catch-all descriptor, and now they're going to be more specific. So hopefully that will lead to more clarity and less confusion with regard to that specific instance. One of the big pluses as well coming with the new form is the proposal to remove the NA, that not applicable requirement, for all optional or unused fields. So currently that is required to be placed in any blank area, any blank field when the employee is filling out the Form I-9. And that has caused some enforcement confusion, because initially ICE had ensured employers that they were not going to be enforcing that specific provision, and then some of them went ahead and did so anyway. And it's kind of a large pain, as you can imagine, for those who may still be using a paper process to complete their Form I-9s, in that the employee would need to go through and write in the NA on any fields that they didn't complete in Section 1, and obviously the employer would need to do so in Section 2. So the new form also is going to edit what is currently 3 boxes in Section 1 that also has a tendency to cause some confusion among those new completers. The A number, the I-94 number, and the foreign passport number, they're looking to consolidate those down into 1 box. And then in addition, right now on the form, there is a big QR code that's kind of down there in the bottom portion of the form that was stated that it was going to be used for audit purposes. But it was always kind of a mystery as to what the exact purpose of that QR code was. And actually, we've never heard anything specific about its usage, so that's going away as well. All right, now let's look at our first poll question. So hopefully everybody knew that over the course of the pandemic, there were temporary measures put in place to allow employers to remotely complete Section 2. Meaning that the completer just had to look, just like we are now. If I was holding up a driver's license, you could complete Section 2 by looking at my document on camera. Now, traditionally, the way that had worked is those had to be a tactile inspection, meaning you had to get your hands on those and you had to review those in person. So we're wondering, did your company use that remote process? Yes, no, but you will if the process is made permanent. And it looks like we've got a pretty good handle, and it looks like over 65 or so % would or did use that remote process over the course of the pandemic. And that's about what I was anticipating. I think we were probably thinking somewhere around the 70% mark. But 65 to 70 is about what one would expect for that, because obviously the remote processes are much easier. And this is also kind of a good segue into what we want to talk about next, not just the form itself, but some of the items that are going to occur in company with the introduction of the new form. All right. So having said that, Section 2 process proposed changes, and when I say proposed changes, I'm talking about items that are temporarily in place now that they are looking to make permanent, right? So the current temporary processes have been extended until July 31st of this year. So July 31st of 2023. And the reasoning behind that extension, it seems, would be to ensure that there is going to be plenty of time to get that new form introduced and ready for these changes in these new processes. So obviously this was in response to the popularity of the remote procedures that were put in place. The Department of Homeland Security issued a proposed rule and actually put forth a call for comments in the Federal Register in August of 2022. So that's been a while, obviously, while we're still awaiting the promulgation of the new form. And I would suspect that it's taking longer because they're trying to wrap all of these items into that form before they roll it out, because it would not be obviously the greatest situation to roll out that new form as quickly as possible and then not have accounted for these changes as well. So obviously it seeks to authorize remote examination procedures. And there are several ways in which they may be looking to do this. It may be introduced as a pilot program, so kind of a test run sort of item, and it may be implemented after scrutiny of security and fraud risk. So they're still looking into all of these items and kind of kicking the tires, so to speak, to see how this may affect people. But make no mistake, some version of this is highly likely to be introduced in the very near future. Now, in addition, and this is why I've made the comment saying that they're likely waiting to introduce that new form before they can get their arms around this remote process, because the form would add a box for employers who are using those remote procedures to check, and therefore auditors would be alerted, oh, okay, so they use this remote process, so we will handle this audit accordingly. One of the other things that's kind of being kicked around with regard to that new process is a mandatory training in document inspection, and then an anti-discrimination training also. These are items that could be required to ensure that you have the right to use that remote process. The good news is I've gone through that document inspection training, and it's just basically to get people who perform Section 2 I-9 completions to that kind of reasonable person space. Would a reasonable person accept this documentation on its face? So would somebody look at it and say, well, sure, I don't see any sort of obvious spelling mistakes. It's not written in crayon. It looks like something a state may put forth, something along those lines. You've got to make sure that you've got your reasonable person hat on when you're inspecting documents. Same sort of thing with anti-discrimination. The key thing there is we don't want to treat non-citizens any differently as far as the process itself goes than we would American citizens. They have, and they being USCIS, has a list of documents, obviously list A, B, and C, and we want to make sure that we're presenting that to everyone so that they can pick whatever documentation may be in their possession to complete that I-9 process. So that would take care of the anti-discrimination. Also, it's important to note that specific conditions may be introduced as a part of this process as well, such as employers using it must also use E-Verify, or there may be an exclusion of any employers who were recently cited for some kind of discrepancy with compliance in the I-9 process. So big things are on the horizon. We don't quite know yet. At first, it was anticipated that the new form might come out at some point in the Q1, and we're rapidly approaching the end of that. So we'll have to wait and see. It's going to be sooner as opposed to later, but we don't really have any exact date yet. Stay tuned to this space, and we will keep you all apprised of the situation and when the new form will be released. The good news is, regardless of the release date, employers will have 90 days to kind of adjust their processes to make sure that they're ready to go after the introduction of that new form. All right, let's turn it over to Wayne, talk a little bit about unemployment tax.
All right, great. Thanks a lot, Gordon. Appreciate that, and appreciate your overview on I-9. That was really informative. So unemployment tax, we being this third party, we have just gotten through what we consider rate season. And of course, a lot of employers are curious. They want to know what does it look like for calendar year 23? What does it look like for the coming years? And so it's quite important to know that we're through COVID, as Gordon mentioned earlier. You know, the unemployment rate overall across the country is down. It's not as low as it was pre-COVID, but you know, we're getting there. And so that's good news for employers because you know, their rates then should follow along with that as well. Fewer claims. And as you know, I'm sure, you know, the more claims you have, just like auto insurance, homeowners insurance, the more claims you have, the higher your rate's probably going to go. So we've been getting a lot of questions, as you might suspect, from our clients on what do our rates look like this year, and why do you think they look like this, other than obviously for some of the claim related issues. So couple of issues that we've been asked about, what's causing rates to go up? What do I have to expect for the coming year? And we were surprisingly really kind of excited for our clients because we didn't see as many increases as what we thought we may. Most of the states have issued or mailed out notifications to employers, letting them know what their rate will be for the upcoming year. I'm sure you know that every year, as an employer, you get a tax rate, and it's based on the historical, what they call experience. Typically, it's about a 3-year period, historical. So once you've gone beyond that 3 years, if you've had maybe a bad year, potentially that's out of the calculation. But for the most part, the states will mail those rates out. Most of them are out before the end of the year, the calendar year, but there are a few holdout states that are still, New York is one that comes to mind, Hawaii, Mississippi. Those are states that will typically generate their notifications to employers in the first quarter of the calendar year. So still before the first quarter taxes due in April, but cutting it a little bit close sometimes. So be on the lookout for those couple of states that are still coming through. The taxable wage base, we've actually saw a little bit more of an increase in that over last year than what I thought we might. The taxable wage base in every state where you've got operations, you have to pay tax on the earnings of every employee up to the certain amount threshold, what it might be. It cannot be any lower than what the federal mandate is, which is $7,000, but it can be as high as whatever the state statutorily will allow for. So we did see some increases there. Some of these states still have not recovered from COVID, even though they got a lot of funding from the federal government and different programs that allowed the funds to come out of a different pool than the overall pool. But what we've seen is probably half the states or more really weren't set up or weren't funded properly, so that if a recession hit, a normal, if you want to use that term, recession were to hit, they would not be ready for that, and they would probably be underfunded and not be able to continue forward without getting some sort of support from the federal government. So when COVID hit, that was like nothing that anybody had ever seen. So of course, a lot of the states, majority of the states really weren't prepared for that. So for the states, the 50%-ish number of states that were not prepared just for the regular recession, they're still trying to dig out from under that. And so in order to do that, they have to tax the employer more. As you know, most of the states have require the employer to pay for that. It's not really an employee funded. A couple of states do, but for the most part, it's employer funded. So they'll do that either through taxable wage base increase, which we've seen here. 41% of the states increased over last year, or they will do something to the rate factors that impact the rate. So for example, if it's a state that uses a schedule, so they come up with a ratio and then they apply that ratio to a schedule, they might increase the schedule so that even though you may have the same ratio as last year, that rate now is a 2% rate instead of a 1.1% or something like that. So all of that in mind with trying to rebuild these fund balances, which were really decimated. And another thing that I guess if you want to think about COVID in any positive aspect is it really did shed some light on how antiquated the state systems were. And so they are going to be, looking into improving those so that we don't continue to have problems there. But regardless, they're still going to be asking employers to fund these account balances so that they continue with this program. So what happens when an employer or when a state can't fund going forward? Well, then they have to get a loan, which it could result in these feeder credit reductions. So they'll get the loan through a Title 12 loan, and we'll talk a little bit more about that. But the feeder credit reductions are what happens if a state cannot repay its loan within the time frame that's outset by law. So this year for the 2022 federal Form 940, you would have seen about 4 or 5 states on there that didn't get their loans paid off by November 10th, I believe is what it is. So they showed up on there, and what that means is you're going to pay a little bit more in tax in those states on your 940 than what you otherwise would have had those loans been paid off. So let's talk a little bit further then about what we're seeing on the rates and the wage basis from a state perspective. So the pie charts are just to illustrate a little bit more clear where we saw some of these changes or whether they did have a change. So for example, on the rate changes, there was a 40% that didn't change anything, 24% increased, and 28% decreased. So the 8% represents the states that that hadn't issued yet. So we really don't have a good framework on that. And then this other pie illustrates the taxable wage-based changes. So you can see there was a 41% increase. If you compare that to what's on the rate side, where there was only a 24% increase. So in some states, you had kind of a double whammy where you got a rate increase as well as a taxable wage-based increase. So when clients are asking us, what do you think we should, what should we do? What should we look for next year? I would say probably similar outlook for 2024, but it's difficult to say because we don't know where the state's going to end up. Most of the state's fiscal years end June 30th every year. So it really depends on where their fund balance falls as of June 30th. So if you're looking at what's going to impact my rate for 24, you really only have a few months left to have an impact on that from a claims perspective or taxable wages. So poll question number 2, we talked about what the FUTA credit reductions were. And so has this FUTA credit reduction greatly impacted you in 2023? As I said, there were only 4 or 5 states where that actually occurred. So maybe you're not in those states, or maybe you don't have a large presence in those states. So lucky for you if you're in either one of those categories. Right now, look at the poll. It looks like, yeah, good. The majority of people either said no or you're not sure. So 7%, yeah, that's good. So yeah, I would say that, going forward, 2024, I'll have a slide here in just a minute that will show you what our outstanding balances are. But California is the one state that has really the highest number, the highest dollar amount of money that was borrowed from the feds to keep their program going, which, kind of makes sense, right? They've got a high population there to stay afloat. And they were incidentally the state that paid off its loan last in the last recession. So I would suspect they will be in that same position with getting this one paid off as well. So looks like we have the majority of people done with responding here. So only 6% said yes, the FUTA credit reduction did have an impact on your business. 39% said no, 45% you were unsure. So that's good news. I think maybe not so much the 45%, but on the 40% no, it did not have an impact on you. So that's good news. But just bear in mind that as Gordon mentioned earlier, if we go into a recession, then that means more people most likely will be unemployed, which then means they'll be filing claims and we'll be dropping those fund balances at the various states. So like I said, not a lot of them have really gotten to the point where they are properly funded or where they should be properly funded if we hit another recession. So I would be cautious. I'm optimistic because of where we've seen some of the impact from COVID hasn't been quite as drastic as what we originally thought it might be, even though there was federal funding. So I think that that's good news for employers from a tax perspective, from an unemployment tax perspective. So FUTA credit reductions, like I said, when a state can't fund its trust fund any longer, they're required by law, obviously, to do that, right? So they have to pay out unemployment benefits when people are out of work through no fault of their own. So when they run into a situation where they can't, or they know they're not going to be able to, they can request a loan through a Title 12 loan. It's part of the Social Security Act. And then they'll request, they can either request like a kind of a reserve, what they say, I think I might need this, our state might need this amount. We're kind of going to put it in a holding pattern. And then if they need it, then it's available to them. So once that happens though, once there is a loan taken out, then that the clock starts ticking. And if that loan is outstanding past 2 January 1s, then if it's not paid off by the following November 10th, then you'll see it as a FUTA credit reduction on the next year's 940, which is what happened this year with those handful of states. So California, Connecticut, Illinois, New York, and Virgin Islands. Incidentally, Colorado, they paid theirs off in the 11th hour. I think it was like the 8th or the 9th of November that they actually paid it off, which was prior to the November 10th deadline. So they skated by, but they did have to borrow again at the beginning of this year. But when I looked on it just the other day, it was looking good that they had already paid theirs off again. So interest accrues, as you might suspect, and that has to be paid off by September 30th in order to not have that also be a part of what additional loan amount that the state might have. So if we look forward here, this is as of January 31st. So like I said, I did take a look at this yesterday. You'll see Colorado's on here as of January 31st, but now they've already paid theirs off again. So maybe they're in a situation where they have to borrow here and there throughout the year, but as long as they don't have a balance over 2 January 1st, they should be good. Illinois, while they don't have anything outstanding because their governor put into laws the payoff of their loan, they do have interest that accrued that will have to be paid. So that'll have to be paid by this September. Otherwise, they'll have a FUTA credit. Virgin Islands has been on here for many years. Actually, after the hurricane hit them, that kind of put them out of commission as far as making any dent in this. But you'll also notice California is pretty substantial, and coming out from under that, they're one of the states that has a very low threshold on their taxable wage base. It's only $7,000. So trying to dig out from under that is going to be difficult unless they either increase that wage base, which they've never done, or change their schedule. And they've been at F+, which is the highest schedule for, I can't even tell you how long. It's been a decade, probably at least. So big changes would have to occur there in order for us to see a big change in that balance. So if I were to say two things that employers have been asking us, clients have been asking us, it's, what do my rates look like? Why have they gone up or down? And if so, why? And then what's up with this FUTA credit? So overall though, like I said, I believe that rates have come down, kind of surprisingly. And so we'll be looking at that very closely over the next several months to determine what we think is going to happen for the 2024 rates, which, how do you even think about 2024 rates coming out already? But like I said, the fiscal year ends June 30th for most states. So a lot of states will be looking at that in July and August. We will take a look at that as well. And then that will give us an opportunity to really, say, all right, we think rates are going to go in this direction for 24, and then have that information available to our customers. So not terrible, but like Gordon said, if we do have a recession that hits us, this could look a lot different next year. That's for sure. So we will keep an eye on that, keep everyone updated on our website so that you'll see anything substantial that's happening, statutory that's maybe out there, legislatively that's out there. Haven't seen anything come through legislatively that would have a big impact, but we're seeing a lot of activity right now anyway. And legislation can be from a tax perspective or on the claim side too. So just a flurry of activity that's going on, but nothing dramatically stands out to us thus far. So So looking pretty good. So from there, I'm going to turn it over to Matt, and he will walk you through any changes and developments in employment tax.
Thanks, Wayne. Appreciate the overview of the unemployment tax, and we'll do the employment tax now. So appreciate the attention span so far as we work through this. A lot of the trends that we're discussing today have really been created, which is no surprise, by a lot of what happened during this pandemic situation. As we get into employment tax, we'll talk a lot about those trends, and hopefully, while the themes may be familiar, some of the trends that we've identified will be helpful as you navigate this regulatory environment, as well as just the practical environment, right? As you're working with your workforce. So we have really two main sections of this. The first one's the shorter one, and it's really talking about tax credits available to employers based on hiring activity. And what are we seeing with trends? So tax credits for hiring are not new at the state and federal level. The work opportunity tax credit's been around for many years. Before that, it was the welfare to work tax credit. And of course, the states, many of them have offered hiring credits to try to incentivize job creation in their states and their local jurisdictions for a long time. So what is new? What is the trend? Right now, we're seeing a resurgence, not a new trend, but we're seeing a resurgence of a trend that's been around for a while, which is to challenge the use of tax credits. So this first bullet talks about this report that was released that questioned whether state tax credits truly result in net new jobs, and whether they truly, the value of those new jobs offsets the decline in revenue, the cost of offering a reduction in tax to corporate taxpayers. This is such a large conversation. There's so many factors. Economists have weighed in on both sides, but certainly a fair question. But we are seeing as we enter into this rougher waters in the economy, have been in them for a while now, a scrutiny and a discussion on how are funds used. If we're going to give people tax holidays, whether it's reducing the income tax, we're actually seeing a movement away in some cases from the reduction in income tax, and there is a focus on what I would call indirect taxes, meaning perhaps it's a property tax break or reduction, or there's a sales tax reduction or exemption. Those can be more attractive because they're attractive to all taxpayers, not just profitable net gain taxpayers, whereas an income tax is somewhat limited in its applicability to corporations who are in a net gain position. So certainly that trend is seeing it challenged. This federal disaster zone retention tax credit was very interesting. In the past 5, 6, 7 years, there has consistently been a federal disaster zone retention tax credit that tries to assist companies or employers who were shut down at least partially due to a natural disaster, a hurricane, a wildfire, tornadoes, flooding, things of that nature. Looking at when employers tried to keep employees paid, even though their operations were considered inoperable due to the disaster. That came up at a very difficult time legislatively in December as part of the spending bill. It did not make it as part of that bill. Obviously, the midterms and the political shift had a lot to do with that. We do hope to see it. I don't know if I want to use the word expect, but we do hope to see something discussed later this year. As again, they're working through a lot of larger ticket items right now, including the debt ceiling. So this isn't exactly front and center yet, but we are seeing more of that. If many of you, hard to imagine anyone at this point who's not familiar with the federal employee retention tax credit, that was based on this disaster zone retention tax credit. So it's, again, not a new program anymore, but something we expect to see returning in light of all of the disasters that the U.S. continues to experience. The trend from that federal disaster zone retention tax credit bullet is that it's becoming much more difficult politically to get these things even part of the vehicle that's being considered at the time of the bill, based on all of the political polarization that's at play now. Many of these tax credits usually get bipartisan support, but it doesn't take much for them to become more of a political football, and that makes it more difficult for them to get the political support that they need to pass. But that is certainly something that we watch very closely. This bipartisan support in Michigan was interesting because it is the reality that is seen here is that the states acknowledge that they need some form of competitive advantage to attract jobs and types of jobs with higher wages that allow their citizens to come out of college and get jobs that justify their degrees, that justify the type of social programs that they're trying to incentivize and encourage. They want local spending. They want local sales tax, all of those things that are necessary. They understand that because one state does it, really all the states have to play in that game. And so this Michigan snippet from this committee really shows that they acknowledge that they need to continue to do that. So kind of balance that against the Georgia report showing that, hey, we're kind of questioning whether these things are useful, to Michigan saying we have to do these things because we need to be competitive. So that's the balance that every state is dealing with right now, and it has been for a while. But we'll continue to see that play out as far as they know they need to spend the money, but then how do they use the money? Kind of going to this last point on this slide, they do want to avoid these perceptions of a windfall. I'll pick on Amazon just because they're so public, and I'm sure they don't care what I say about them because they're doing just fine whether I talk or not. But Amazon's HQ in New York that was so public and so well advertised, and trying to negotiate these really incredible tax incentives in order to create hundreds, if not thousands, of jobs and these local jurisdictions, really highlighted the fact that the public, if they get behind or they get in front of something, can really kill a deal. And so this becomes a very difficult environment to navigate if you're a large employer, even a small employer. It becomes even more difficult if you get that incentive and then a few years later, you haven't created the number of jobs, or you have and it hasn't had the stated impact on the economy, which, as I mentioned before, can be very difficult to measure anyway. Even if you create that impact, it can be difficult to prove that you created that positive economic impact. So to navigate that perception is becoming more and more difficult. Enter clawbacks, enter different ways to fund the desired activity, the job creation, the training, the prevailing wage increases. So you're looking at, again, those indirect tax benefits that are more attractive to some companies and frankly less scrutinized. Again, this employee retention credit at the federal level, the Form 941 or 941X, is not a public document. It's not like the Paycheck Protection Program where the reports and the participants are published so that everybody can see them. Many of these indirect tax returns are not even subject to FOIA request. And so you do have some protection if you're the employer. So there is a way that companies can work with official state and local. So moving into the second piece of this, sorry about that. Moving away from hiring incentives and really moving into employment tax and labor law issues. This topic has come up a lot in the past few years. Again, as I mentioned earlier, really came up as a hot topic during the pandemic. Many of you are probably familiar with this lawsuit that's cited here, the New Hampshire versus Massachusetts case, where New Hampshire was very upset that their citizens were paying taxes in Massachusetts. The Supreme Court declined to weigh in, really, as the Supreme Court has trended to in the last few years, hoping that the legislatures would fix that they didn't have to. But this is really a rule that's, as you can see, 5 states have this rule. No surprise that most of those states are in the Northeast and are smaller than some of the Midwest and Western states, meaning they have employees or citizens that may live in one state and work in another state. The reason that's so important to the applicability of the convenience of the employer rule is because it says that from a withholding tax perspective, you're going to be treated as far as which state owns your employment based on the state that you work in, not necessarily the state that you live in. If you're working from home, let's say you're working from home in New Jersey, but your actual headquarters, the office that you are assigned to, that you generally report to, is in New York State, and your home is in New Jersey, happens all the time, and you're working from home. The states in this convenience of the employer rule will look to why you're working from home. If you're working from home because your employer requires it, then they can look to move your home state to New Jersey in that case. But if you're just working from home because your employer allows it and you can choose where you want to work, then New York's going to say, hey, you're a New York worker. We're gonna tax you as if you're a New York worker. And of course, then some reciprocity rules may need to be reviewed to see whether there's any reciprocity that can help the worker at that point and the employer. But absolutely, this is a hot topic and is becoming a hotter topic in these types of states. So what this happened in New Hampshire with them saying, hey, if we have all these people that live in Nashua, New Hampshire, and their home office is in Boston, but they never go into Boston anymore. They live in New Hampshire. They went and bought a home here during the pandemic, and they can work just fine remotely. They shouldn't have to pay taxes in Massachusetts. And Massachusetts said, yes, they do. The rules are longstanding. We're going to make them do this. And this is where the Supreme Court declined to weigh in on it. As it says here, New York is notorious for this, but New York is a very tough state from an employment tax perspective in general, meaning some states require that you work in that state for 30 days, and we'll get into this in a minute, before you are considered actually working in that state for tax purposes. New York says 1 day. That's enough for you to at least have to start tracking that and reporting that. Frankly, if you even think about working in New York, it feels like you're going to have a tax liability there. So they're a very tough state in general. In other states, as you'll see, like big states like Texas may not care as much because most people are going to be working safely in Houston or Dallas, which, having grown up in Houston and now living in Boston, I can drive pretty much anywhere in the Northeast in shorter time than it takes me to get from Houston to generally any Texas city. So just kind of the geography is funny because it kind of controls how the taxation plays out. Again, we alluded to the multi-state income tax withholding earlier. I think the biggest takeaway, the trend that we're seeing, and this is coming up more and more often, two trends. Number one, this is not a new trend, but the problem is the trend here. The problem is that very few, if any, employers, especially large employers, are compliant and accurately withhold for income tax purposes. It's very complex. It's very difficult to track the movement of all of your employees, especially now that everyone's got a laptop and they can hop on in a car or hop on a plane and be wherever they want to be in a couple hours and then work from there without anybody knowing about it. This actually happens a lot with executives who may want to leave Boston, as we all do, for the winter and head down to Florida and work down there without telling anybody. Then it raises tax issues that are very difficult to track. So the trending here is that it's becoming harder and harder to be compliant with these income tax withholding rules. Not just because the rules themselves can be difficult from state to state, but because the mobility of the workforce is becoming much more agile. The other trend that we're seeing is that states are starting to care a lot more about compliance and audit a lot more and crack down on this, because as they look at, as was discussed previously, Wayne kind of alluded to this, with states looking at their deficits and how to cover some of those debts that they owe. They're saying, hey, we need to focus on more than income tax. Let's go crack down on some of these employment tax liabilities that we've never really looked at before. And so we've started to see larger companies, working at Ernst & Young for many years before I came here to Experian, working with Fortune 50 companies that were getting audited and owing millions of dollars, if not tens of millions of dollars at sometimes, because they weren't tracking this very carefully. The solution here is often very practical. It's really developing a policy that your HR team and your tax team have co-developed on all of these topics so that you can work through it, and so that HR knows that they're going to approve somebody moving or working remotely, that tax can weigh in on whether that's going to create nexus, whether that's going to create withholding tax issues, or any other tax implication that there may be. So instead of tax or HR making decisions in a vacuum, having a co-developed policy and process can really solve a lot of these issues. There's a proposed solution with this Uniform Nationwide Mobile Workforce State Income Tax Simplification Act. There's a big push for any of these multi-state uniform acts. The states are just always hesitant to give up any of their individual sovereignty and giving into those multi-state uniform policies. As far as which states is this applicable to, it's going to be it's going to be almost all of the states when it comes to income tax withholding. These rules about whether there's reciprocity that needs to be looked at. Convenience of the employer, however, is going to be very specific to these 5 states listed in the bullet: Connecticut, Delaware, Nebraska, New York, and Pennsylvania. Those are the ones you need to look out for. If you're not in those states or you don't have employees in those states, you should be pretty safe. Brings us to our 4th polling question. How comfortable are you that the activities of employees are taxed correctly based on the location of services? We could have stopped at just taxed correctly, and that could have been a difficult question, but we'll add based on the location of services to just make it a little bit more complex. I'm saying that right off the bat, we're at somewhat comfortable, some risk, but not material. I see that a lot. And it truly is one of the things you can learn to live with if you feel the materiality threshold on that is appropriate. Looks like everyone here is either very or somewhat comfortable. And a few I don't know. There may be some who are very or somewhat comfortable. Don't know either. All right, for sake of time, we have 7 minutes left. I'm going to move through minimum wage as a trend. I'm not going to spend a lot of time on this. Again, we want to leave a few minutes here at the end to wrap up. But as we've all seen, the higher minimum wage, that is going to, if all the things that we just discussed can weigh into, from a regulatory environment, from a tax environment, what people are paid based on the state that they're seen to work in and what state controls the labor law, which sometimes can be different states. And that can be a nightmare from HR as well as from a tax perspective. This slide, independent contractor versus employee, is obviously a hot topic and a trend. We frankly could have spent an hour or more on this topic alone. We want, but really paying attention to the rules that are being developed. This California bulletin that's quoted here, that's cited here, is very interesting in looking at this ABC test that they've established. And I will say, again, in 20 years of my career doing this and looking at contractors I've worked with, I would think, whether I was at a large accounting firm, whether I was here, whether I was anywhere, it's very difficult to meet that contractor test, that independent contractor test. Almost most independent contractors, based on how they're set up in most corporate environments, probably a very strong argument that they should be treated as common law employees as opposed to independent contractors. And this is where states are really seeing something they can move the needle on. So they're getting more aggressive. California is somewhat leading the charge there, but the other states are looking at it. The note here about the IRS and the DOL, the IRS has issued this, or the APA has issued this letter to the IRS asking them to conform their standards with the DOL. It can be very difficult for an employer trying to meet both standards and understand the implications of the DOL standard versus the IRS standard. And oftentimes they overlap. It's a Venn diagram. I'm not going to cover this last slide. Just, we have 5 minutes left. I don't want to rush this so much, except for to say that these new FMLA paid leave benefits that have been arising in these states, some of them are arising because the federal paid leave benefits aren't sufficient. And so they're trying to become more attractive. They're trying to provide greater benefits, but understanding the paid leave benefits. And for you as an employer, understanding if there's a tax offset. Oftentimes there's a tax benefit to the employer for complying with these FMLA paid leave benefits or state versions. Or if you go above and beyond the required benefit, there may be a tax benefit to you going above and beyond. So looking at how that is controlled, what the regulations are, as well as what the tax offset may be, is very important on a state by state and federal basis. Mara, I think I turn it back over to you to see if there's any questions that we didn't answer and wrap up.
I think we do. So I think we'll do really quickly through 2 questions that we have that I see that we have, and maybe we can just hit them really quickly. So the first one is, what is the biggest mistake you've seen companies make in trying to manage their unemployment costs, and how did you get past it? You know, in the interest of time, I might switch over to the next one. So I think this one's for Matt. So we are struggling to keep up with tax regulatory changes. Do you have any advice for us?
It's difficult. I don't know that there's any single solution. There's not like a software off the shelf that you can buy that keeps you up to date with all those updating regulatory changes. Hopefully you have a trusted advisor, I would call them, that you use, whether it's a CPA or an accounting firm that can provide updates. If you look at A lot of the big four accounting firms publish on an annual basis booklets that show the updates and the regulatory changes to income tax as well as employment tax issues, unemployment taxes that Wayne's discussed. So grabbing those and reading through them can be helpful. And then obviously webinars like this can be very helpful. I haven't seen a silver bullet that would give everything to you in one place very quickly, though.
All right. Thanks, Matt. Wayne, do we have you back?
I don't know. Am I back?
Yes. Yes.
Okay. Sorry about that. That's weird. All right. So if I had to guess or say what I would say two things. One is probably what Matt was talking about with sourcing. A lot of times employers will think that people are independent contractors when they're not. And then the states will retroactively go back if they determine that they really should have been reported as employees. And then you'll have interest and penalty and that sort of thing. And then the other thing has to do with reporting of any type of corporate structure change. So acquisition, divestiture, corporate reorg, and especially mid-year, because a lot of times employers will start over paying taxes. We talked about that wage base, taxable wage base. And once you've hit that threshold, a lot of times if you're reorganizing, acquiring, you can take on whatever was previously paid by the prior FEIN can be transferred forward to the new one. And a lot of times either employers don't have the time to look at that, they don't have the data, they don't have the resources, and so they just don't. And then they're double paying basically. So that would be my thoughts.
All right. Thanks, Wayne. I think we are just about out of time. So I have some information on where you can learn more from Experian Employer Services. And I will let you look at that slide, and I'm going to pass it back off to wrap up to Eric.
Thank you, panel, for that excellent discussion. And thank you, everyone in the audience, for joining us today for this fantastic webinar. Thanks again, and enjoy the rest of your day.